My name is Guy Wagner. I'm the Chief Investment Officer of BLI, Banque de Luxembourg Investments. When we talk about a new world or a new environment for financial markets, what we basically mean is that whereas in the past you traditionally looked at the economic cycle and inflation, growth, and nowadays there are other factors that you have to take into consideration, and these are things like demographics, the changing geopolitical situation, the very high debt levels that we have in most of the industrialized countries, and all these factors together mean that the way we look at the asset classes, the correlation between asset classes is starting to change. The implications for the economy, when we look, for example, at growth, you could say that because of demographics, because of a declining active population, normally that would lead to lower growth because less people are working, unless this is compensated by very high productivity gains, which is possible with technology, but far from certain. And when you look at inflation, I think we're entering a more inflationary environment, whereas the past years were basically characterized by very low and stable inflation, somewhere between 0 and 2%. I think in future inflation will be structurally higher. 2% will be the floor and not necessarily the official target anymore. A less stable geopolitical environment, interest rates, which basically they can maybe decline a little bit, but the potential to decline much further is basically no longer there. So we have some of the factors which in the past years or even decades were very good for financial markets, which are starting to change. So I think one has to be aware of that the environment might become more difficult. That being said, I think we're still in an environment where one has to look at real assets and not monetary assets. So what I mean by that is one still has to favor equities over bonds. One has to favor gold over paper currencies, because I think we are in this kind of environment. I would say that you have basically the choice between two kinds of approaches. You can either invest or you can speculate. Both are perfectly fine, but you have to choose what you want to do. What I mean by that is we consider ourselves to be investors. So when we buy equities, what we typically do, we take a long-term stake in a high-quality company and we pay attention to the price we have to pay. So we look a lot at fundamentals, whereas if you're a speculator, what you basically do, you buy a stock and you try to sell it to someone else at a higher price. So fundamentals might not be that important. We clearly are active managers, but one has to be aware the trend over the past years has gone in the direction of passive investing, which basically often means you're buying an index. The weighting of the different companies in that index is based on their market capitalization. So the more a stock goes up, the higher the market capitalization, the higher the weighting, the more money flows into that stock. So basically you have a very pro-cyclical approach, whereas we as active manager try to get a little bit away from that and again look much more at the fundamentals.